In this video we're looking at the BCVR entries for inventory. So from the question we know that the inventory is recorded in subsidiaries accounts at $20,000. However, from a group perspective on acquisition, that inventory was valued at $25,000. So that means that on acquisition we had to record a fair value adjustment of $5,000. Now we work with a time frame of 6 months in this question. So the acquisition date was 1st July 2014. We prepared the consolidated financial statements at the end of December. Now we normally assume that the inventory will be sold within the operating cycle of a company. But because this is now only for 6 months, the question tells us that of this inventory that was on hand at the 1st of July, 90% was sold by the 31st of December. So therefore, by the 31st of December, in our BCVR adjusting entries, we'll see two set of adjustments. First of all, for a fair value adjustment for the 10% of the inventory that is still on hand, and then secondly, a transfer from the BCVR to retained earnings for the 90% that was sold in the current year. So here you can see first of all the entry for the 10% of the inventory on hand that needs to be revalued to fair value, and then the entry for the 90% of the inventory that was sold. So the fair value adjustment on acquisition date was $5,000. So if 10% of that was still on hand, it's 10% of 5,000 that we still need to increase our inventory value with. Because we adjust the accounting base of our inventory, it's going to result in deferred tax consequences. So we raise the deferred tax liability, and the balance goes to our revaluation reserve. And that's our normal inventory BCVR adjustment for revaluing our inventory to fair value. Of course, by the time that inventory has been sold, in following years, this entry will not be made anymore. So we only make this entry for inventory if there's any inventory on hand. With regards to the 90% inventory that was sold during the year, let's just first of all take a step back and think what the entry for selling inventory would be in the subsidiaries accounts. So the entry would be to debit cost of sales and credit inventory. So with regards to the $20,000 inventory on hand in the subsidiaries accounting record, so if 90% of that was sold during the year, be debit cost of sales with $18,000, credit inventory $18,000. However, from a group perspective, inventory was valued at $25,000. So from a group perspective, the cost of sales had to be 90% of $25,000. That is $22,500. Credit inventory $22,500. This is what's going to flow through from the accounting records of the subsidiary. This is what we would like to what we have to have in the consolidated financial statements as the cost of sales for the group. So we need an adjustment of $4,500 to get us from the subsidiaries accounting records to what it should be from a group perspective. And that is exactly the adjustment that we then see in our BCVR for the current year. So with regards to the 90% of inventories sold, the cost of sales of the group is understated by $4,500. So the cost of sales from a group perspective need to be increased by $4,500, so that when we've passed this BCVR entry, our cost of sales will be $22,500. Okay, so we increase the cost of sales with $4,500, so that when we add it to our combined results of the subsidiary and the parent company, it would reflect what it should be from a group perspective. We also reverse the deferred tax liability because of the inventory that has realized or has been sold and derecognized. So we reverse the deferred tax component of that asset. So that's 30% of the $4,500. And instead of creating a business combination valuation reserve, we transfer it to retained earnings. So this entry, even though it's got a long description, actually hits the retained earnings account. And this entry is only passed in the year in which the inventory is actually sold. So to recognize the realization of that inventory.